Welcome to the Purpose-Based Retirement with Certified Financial Planner Practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Hello investors, welcome back to the program. I am Lee Kelso here with Casey Weade and Marshall Johnson, Certified Financial Planners with Howard Bailey Financial. On our program today, a special guest. He manages billions of dollars in assets for investors just like you and me. What should we be looking for as we head toward retirement? It's right around the corner for me, and if you're already retired, I think it's even more important that you hear what he has to say. Casey will introduce him in just a moment. And of course, we have questions from our viewers, so we hope that you'll join us for the rest of the program and really learn more about your investments in these changing times. It's such an important time to be paying attention and thinking in a whole different way. So Casey, I want you to get started and introduce our guest.
Today we're here with a good friend of mine, Mike Sorrentino, also a partner of Howard Bailey Financial. You know, when we manage our clients' investments, we believe that it's prudent to have a team that's watching that portfolio day in and day out. Our job as financial planners, especially as certified financial planners, is to guard you against the major risks that come with stepping into retirement, guarding against all of those potential liabilities, not just investment liabilities, but all the major liabilities that you will face during retirement, and helping to keep you on the right path. Today we've got Mike Sorrentino with us, which is the Chief Investment Officer of Global Financial Private Capital, overseeing a $6 billion portfolio of assets that are managed from clients across the world. He's also a chartered financial analyst, and he's going to be discussing with us alternative investments, private equity, what it means to be an institutional money management firm, and how you can step out of that old retail world and into the institutional money management world. Hey, Mike, welcome to the show.
Great to be here. Thank you.
You know, I think it's good to kick things off here today. We often talk about, hey, you know, we do outsource things to a third party in many instances to manage our clients' investments, especially when it really calls for a more sophisticated strategy. And I've often heard other advisors say, you know, we do everything in-house, and they're very proud of that fact that they're managing that portfolio in-house for that client, so they can always talk directly to their investment management team and be very close to that individual. Why do you think it's important for someone to have a third party such as yourself and do things like this?
I think really what it comes down to is that if you think about the sophistication that's in markets today, it's very, very difficult to do something like this in-house. I mean, you could build your own team. Large enough firms could probably get away with that, but we're talking about millions in salaries you have to pay. We're talking about access to technology solutions that are incredibly complex and sophisticated. My budget alone with my group is millions and millions of dollars a year. So you'd have to go out and find the talent, put all the strategies together, look for all the resources necessary. It's a very, very difficult thing to do internally without having, call it the rigor and access to capital and talent that's available through a firm like Global or one of our competitors.
And size is able to get you there, right? At $6 billion, you're able to throw some weight around and get some really good talent, PhDs, CFAs, MBAs, people that are not just people, but a whole team of people with probably dozens, if not hundreds of years of combined experience, now sitting at the same table and managing that client's portfolio on a day-to-day basis. And that's what I want my clients to know. I want them to know that there's always somebody managing their investments. It's not something we just throw something into and rebalance once or twice a year or quarterly, or change one investment here or there. We're actually analyzing every single position in the portfolio with a very large team, a dedicated team that's dedicated to them to manage their life savings. That gives me peace of mind, and them, I hope.
Yeah, and it's just another layer of due diligence, right? We need need to do our due diligence on Mike, and Mike's doing his due diligence on other money managers, and we just want several layers of eyes focusing on those strategies to make sure we don't miss anything.
Absolutely.
Yeah, you know, I liken this to my son. You know, my son is 2.5 years old today. He's got a 529 with about $10,000 in it. And, you know, we bought some mutual funds. You know, we didn't outsource it to a third party as an institutional money manager, right? He's still in that retail mutual fund world. Now, someday, hopefully he has hundreds of thousands of dollars and he can step out of that retail world over to the institutional world, lower his fees, lower his expenses, increase his tax efficiency, have a more hands-on approach, have a bigger team that's managing that portfolio just for him. However, he's 2.5 years old. And if we're still investing in that old mutual fund world, we've got 10, 15 different mutual funds in our portfolio of just stocks and bonds, you know, we're not getting the level of care that we could be getting with an institutional management team.
No question about it. The difference between institutional and retail is huge. And again, the institutional experience for so long was preserved primarily for the institutions. A lot of the things that they had access to, you mentioned earlier, pricing, technology, the way that we invested, tax management strategy, all these different strategies available to the institutions, we could never get it to the retail investor, except for over the last maybe few years. Technology has really been able to allow us to bridge that gap.
Now, why do you think today it's more important than ever that investors start to look away from that retail world into the new institutional world that they actually have access to? And I say new, but it's been around for a long time, right?
It's new to retail.
Yeah,
exactly.
It's new to retail, though. Now, investors with smaller account minimums can get into places like this and have institutional level management. Why is that so important in the world we live in today? Is there something different about the investment world today than there was 10 or 20 years ago that we have to make this shift?
Oh, I think there's a huge difference. I mean, think about this idea, that old 60-40 playbook that everybody alludes to, this idea of owning diversified stock and bond portfolio, and that's going to get you through retirement. Now, I think we all can agree today is a little bit more, feels a little bit more complicated than it was even 10 years ago. Sure. I mean, how could a 60-40 portfolio get anybody through retirement right now? If you look at the yields in the bond market and the S&P 500 alone, they barely break 2%. So just if you need income, you couldn't possibly use this type of a solution. So the institutions know this. So if you go back to 2008, when everybody thought they were diversified, it turns out they weren't, the institutions didn't have that problem.
Now, when you say institutions, what does that mean? What institutions are out there that we should be aware of, and maybe we can even look into their track record and what they hold?
Oh, I would look at Yale University. They're one of the poster childs. Their endowment has done phenomenally well over the last 20 years because the chief investment officer, his name is David Swenson. He was an individual back in the mid-90s who also saw that the future for the 60-40 playbook didn't look so bright. He was ahead of the curve. So what he did, he made a dramatic shift into other asset classes. These asset classes do not move with stocks. So you think from his perspective, or the other institutions that followed a similar pattern in 2008, they didn't have to make a call whether to get out of stocks or not. They were already so well diversified, they just let their system run. And that was the key. That's why the endowments, that's why a lot of the institutions actually did quite well in 08.
Now, one of those investments that we often see, we might call as an alternative investment, would be private equity, right? Yeah. And this is a chart that you shared with me prior to the show, and I thought it might be nice to share it with the audience and just kind of explain what this chart means.
Absolutely.
And why it's important.
It's very important. If you think about public equity versus private equity, when we talk about private equity, we're talking about investments typically in private companies. They're not publicly traded. So if you look and you compare private equity returns to total world return in equities. And if you can see over a 5, 10, 15, and even a 20-year time horizon, we're talking close to double the return in the private market versus the public market.
And you're saying that the average investor can now get involved in private equity somehow?
Well, they can't necessarily invest directly with private equity funds. Think of these as country clubs. You got to have a lot of money to get in, and they still may not let you. Right?
So how do we add these things to our portfolio?
And exactly. What we can do, though, is think about real estate. The 3 most important rules in real estate, we all know them, right? Location, location, location. All right? That means if you pick the right neighborhood, that's going to actually explain about 93 to 94% of your long-term returns. And that's how it works in investments. Asset allocation is everything. So if we can figure out where private equity is investing its capital, what sectors, what geographies, those types of situations, if we can figure out where they're investing their money, which we have funds that will do that, then we can replicate the return stream that we see in private equity by investing in liquid securities. Okay, what I mean by that are ETFs and stocks, bonds, things of that nature. We can invest in these securities to try to get in the same neighborhood that private equity is in. Now, we may not get 100% of the return stream that you see there, but if we can get 93, 94%, somewhere in that range, and do that in a liquid manner, because remember, private equity investments, you're locked in for 7 to 10 years. You can't get your money back. Right?
Well, it obviously adds a lot to the overall mix, and I think this is one of the things that people have to be aware of, that it's out there, and now it maybe turns your head to look towards an institutional manager away from that retail management firm in order to add more diversification to the portfolio and be prepared for this next stage of your life.
That's why I hope that you'll take advantage of this opportunity I'm about to explain to you, and that is to be one of the next 10 callers to call the number on your screen right now and you receive a complimentary review of your entire financial and retirement plan, because as you just heard, the rules have changed, the world has changed, and is your plan keeping up? Well, if you're not sure, be one of the next 10 callers and you can sit down with Casey Marshall, another member of the Howard Bailey team, and get your very own purpose-based retirement. All right, we're back with questions from viewers in just a second.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
Time for us to answer viewer questions, and we're going to begin today with Steve from Elkhart. Steve.
I've been the money man for the family since we were married, and as I get older, I want to get the wife more involved. What do we suggest we do?
Well, you know, I think the first thing you should do is tell her you're going to go out to a really nice dinner, and then schedule an appointment with Casey or I, and then just drive right in the driveway and say, before we go, we're gonna have a little sit down here. No,
better not do that.
Yeah,
it's a bad idea.
All kidding aside, I think it's great that you're doing that. You know, there was a previous generation that didn't talk about money, spouses, even between spouses, they didn't talk about finances, and so I think that's a great thing to do, because we've all seen it. You know, Casey and I and everybody at our staff has seen it, where people have become burdened by the death of a loved one or a spouse. So you're doing the right thing. Get that, but ease into it. You know, maybe dangle a nice meal out there.
Yeah, well, there's nothing wrong with that. You know, I know between my wife and I, we like to sit down quarterly and do a complete financial plan review, so she knows where things are if something happens to me. It gives me a great deal of peace of mind, and her as well. She's also got everything in writing. I've got a couple that I started working with about a year ago now, and when they first came in, they didn't come in together. He came in by himself. It was just him. He sat down, said, I'm ready to retire, but my wife doesn't want me to because she just hates this stuff. She doesn't like money. She doesn't like finance. She doesn't want to talk about investing. She doesn't even want to think about retirement. And what we did was we put together the complete retirement plan. We sat down 2 or 3 times. We had a very detailed plan laid out, a written plan that not only he knew he could understand, but he could communicate and she could understand as well. She came in when we ultimately delivered the plan. We walked through the complete written plan, and she understood it so much so that when she first walked in, very standoffish, by the end of the meeting, she was giving us hugs. She was very happy that her husband was stepping into retirement. She saw what it was bringing out in him and what it was going to do for him in his life, and that they had made it. They just needed to have a detailed written plan. Even if you can't get your wife to sit down, or your husband for that matter, to sit down with a financial advisor and walk through the plan, it's a great idea to have it detailed and written out in case something happens to you. At least he or she knows where that piece of paper is that tells them exactly what to do, where to go, and how to find everything.
Great advice. Paula from Decatur is up next. Go right ahead.
How does continuing to work while I draw my Social Security benefit affect the benefit I receive?
Well, thank you for your question, and it will affect you, but it kind of depends on your age. So if you retire at age 62, then it's going to be an income limit, and in 2017 it's about $17,000 that you can make. And if you start creating income, W-2 income, over and above that limit of $17,000, they start reducing your Social Security $1 for every $2 over that income limit of about $17,000, $16,920 to be exact. And then once you reach your full retirement age, and so those born between 43 and 54, that full retirement age is now, it's creeping up from 66 all the way to 67 if you were born 1960 or later. So in your full retirement age, then it's going to be a little different. They're a little bit more lenient. You can make quite a bit during your full retirement year. That's about $45,000 that you can create in income during your full retirement year. And now above that, they'll reduce your benefit $1 for every $3 over that much larger limit. Not $17,000, but closer to $45,000. And that gives you a lot of leeway. And this is a reason that a lot of people wait to start their Social Security until they're fully retired or they're working very menial part-time jobs. And you know, there's also some unique things. If you're a farmer, you might think about putting the farm in the name of the spouse that's not going to draw Social Security so that the other spouse can begin drawing Social Security and not get impacted by that income. So just some things to think about.
Arthur from Fort Wayne's up next. Go right ahead.
We're thinking about buying an SPIA. We bought one several years ago at 4%, and it'll be up soon. We're wondering if this is the best investment avenue today.
Well, thank you for your question. What you're talking about is something that we refer as a SPIA, a single premium immediate annuity, which creates a guaranteed income stream that you can't outlive. The unfortunate part about SPIAs is you lose control of those dollars, and there's never a worse thing to do in a low interest rate environment than annuitize your life savings or lose control of it in a fixed instrument such as that. And we call that not just annuitization, we like to call it annuicide at Howard Bailey Financial. You don't want to lose control over your life savings. You want to maintain control over those things. And it's important to understand what that 4% you mentioned really means. Now, the highest SPIAs in the country might pay you as much as 6 or 7% cash flow. But what that means is you're getting cash flow, not a return on your investment. So if you're 60 years old, you've got $100,000 that's going to give you 6% a year. Now you're going to get $6,000 a year every year for the rest of your life. If you get to be 70, now you've got 10 years of $6,000, you've gotten back $60,000. You have not received a single return on your investment yet. You have to outlive or live long enough in order to actually start to see a return on your investment. This is why today we really advocate looking at, if you want a guaranteed income stream, you might look into hybrid annuities, fixed index annuities, or better yet, put it someplace where you can earn a decent rate of return without taking on a substantial amount of risk and just take withdrawals. Now you have less cost, you have more flexibility, and you have the ability to know if you pass away tomorrow, you're leaving asset behind, and if you don't need the income stream, well, you don't have to take it.
Yeah, and I think this kind of goes back to those points of some people hate annuities. Well, a lot of people assume that you have to give up control of that lump sum in exchange for that income stream, and that's exactly what a SPIA is, right, or an annuitization. And so they may have had a parent or somebody that had that, and it was a frustrating thing for them. So be in the know and check current rates.
You know, I can say very rarely we might do something like that. I mean, incredibly rare, so rare that I think we might have only done one in the last 12 months for a very specific purpose. So sit down, understand why you're doing things before you take those action steps.
And here's an opportunity to learn more about why you might need to take those action steps. Be one of the next 10 callers at the number on your screen, and we're offering a complimentary review of your entire retirement and financial plan, a chance to get an education about your money so you can make really strong decisions for yourself moving forward. So be one of the next 10 callers to call the number on the screen, and you can get on the calendar with Casey, Marshall, or another member of the Howard Bailey team and wind up with your very own purpose-based retirement. All right, our question of the day has to do with money managers. What percentage of active stock managers failed to beat their benchmarks over the previous 1, 5, and 10-year periods? You might be surprised at the answer when we come back.
Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a purpose-based retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
Going into the break, our question of the day had to do with how well are financial managers doing against the benchmarks in the market. So our question was, what percentage of active stock managers failed to beat their benchmarks over the previous 1, 5, and 10-year periods? And Casey, some people are going to be surprised at this one.
Well, Lee, the answer is actually 90% of active stock managers failed to beat their benchmark over the last 1, 5, and 10-year periods. That's 90%. That means the majority of active managers out there aren't beating their benchmarks. Now, I think that's a concern that a lot of retirees have, and it's become even a larger concern over the last 5 to 10 years as we've seen the Vanguards of the world, the Spiders of the world, the index fund world really explode. And now we've got people like Warren Buffett and Jack Bogle that are telling us that we need to stay invested in low-cost index funds because our money managers are going to charge us too much in fees. We're not going to be able to beat the market indexes. And that's why I want to talk to Mike Sorrentino here today, because Mike manages a $6 billion active management portfolio, and there keep continuing to be more and more assets headed your way, and it's one of the largest RIAs in the country, not only one of the largest RIAs in the country, but one of the largest and fastest growing registered investment advisory firms in the country. So if it's true that everybody underperforms their benchmark, then why would we possibly want to utilize an active money management team like yourselves?
I think it just depends on the situation. Look, I mean, we can go back to 2008 when the S&P 500 was down 39%. If you're down 32%, are you going to go ahead and brag to your friends that you outperformed your benchmark?
Yeah, well, when are we going to brag to our friends?
Yeah.
Right?
Well, when you brag to your friends when you live a happy, safe retirement, and that's really the goal. You talk about benchmarks. Retirees' benchmarks are very simple in my mind. All right, they want to make sure that they don't run out of money in retirement. They want to live a comfortable retirement. They don't want to worry. And that's the idea behind active management, a large portion of active management. Sure, there's some managers out here that are probably never going to beat the benchmark consistently. That statistic probably sounds right. But what we're focusing more on here are making sure our investors, over the long run, achieve their financial goals.
Yeah, which is really all about protecting them against their liabilities. You know, I've got friends all the time that'll come to me and say, hey, Casey, will you manage my portfolio? I say, well, you really don't need me. I mean, really, there's nothing wrong with what the Bogles of the world said. Go out, buy a low-cost index fund, dollar cost average into that fund over time. You'll effectively be timing the market without having to know anything about it. The market's low, you'll buy more of the market. Market's high, you'll buy less of the market, and you'll keep your fees and expenses low. But sooner or later, you're going to accumulate enough assets where it's going to be a real heart-wrenching experience when it drops 30 or 40%. And in that experience, now it's time to make that transition to an active money management team that can say, we're here to protect you. And we'll also work with a financial planner that's not just a money manager, but a financial planner that's going to focus on those other risks that you're going to face during retirement to make sure you're positioned correctly, be that inflation, long-term care risks, emergencies that might rise during retirement, or just longevity for that reason. However, we've seen more and more retirees retiring, right? We've got about 10,000 people turning 65 every single day, but we continue to see more and more dollars pour into these passive index funds. As we can see from this chart, we can see the inflows, right? The net inflows into stock mutual funds and exchange traded mutual funds. Now all of a sudden these yellow lines are shooting down dramatically, right? And the passive funds, that black area, that's where all those funds are going. We're seeing these outflows from active management into passive management, right?
Oh, well, yeah, we're definitely seeing that right now. But the key component here, like everything in this world, it's cyclical. Right. So when the market's ripping and we have low volatility, like we've seen over the past couple of years, passive makes a lot of sense because everybody thinks that they're a genius, right? Everybody thinks, oh well, the market's going to go up, so I don't want to pay fees, which is fine. Like you said, people in their 20s and 30s, they don't need active management, but that only lasts for so long. Right? Cycles exist almost indefinitely in financial markets, and at some point it will shift. And when things do shift, then you're going to see that flow back into active management because, and as you can see in the chart here, this is a cyclical event where we're going from over the past, 25 years or so. that's what happens is when the market gets weird or gets a little crazy out there, people get spooked.
And everybody wants to go back to active management, right?
Because they want someone to help them through the volatility, through the mess.
Yeah, I think those are the things that retirees are looking for. I mean, Lee, speaking from your own personal experience, as you get closer and closer to retirement, would you be more comfortable just buying and holding the S&P 500 and hoping everything works out, or to have a more active team that might actually even underperform the S&P 500?
Yeah, I'm not concerned about meeting benchmarks. I'm concerned about what's important to me, and that's income. And can I generate that with just dividends alone? Probably not. I don't know that well enough to know what I'm doing. That's where I want a professional on my team.
Yeah, not just one professional, but I think an entire team, right? We want a PhD, we want a CFA, we want everybody watching this on a day-to-day basis. I think this chart also really illustrates your point on this cyclical feature of passive versus active funds, right?
Yeah, absolutely. If you think about what we're seeing here, just recently over the past, since the financial crisis, that gray indicates that passive is outperforming active, which makes sense. We've seen that over the past several years. You mentioned earlier, Vanguard, their assets have exploded they're in trillions now. Yeah. Right, but if you go back to the last two recessions, the financial crisis and the dot-com blow up, it's a different story.
Right.
Look at active.
We can see that people want that active approach during those bad times. And I think when we see a market that's getting as expensive as it is today, when we see a bull market that's been on the second longest bull run in history, this becomes a time where we start to question, should we still be passive today, or should we start to look at more active managed strategies and also into different asset classes, right? Yeah. So it's not just about stocks and bonds. We've talked about this before. It's not just about that old 60-40 playbook, a 60% equities and 40% fixed income, buy and hold and hope everything works out. Retirees and in this low interest rate environment, all investors need to be looking into other asset classes, right?
Oh, no question about it. And that's the key idea here is that there are asset classes out there that don't move with stocks. Okay, so that's number one, that gives us that diversification. Right? When stocks go up, other asset classes may not participate and vice versa. It smooths the ride out over time. But there are also several asset classes out there that have a higher expected return over time, the ones that the endowments and the large institutions have been using for years. And they have that higher expected return because there's a level of sophistication required that not everybody knows how to do these strategies. And that's the key component here is that if you can go out and find managers to fish in different ponds, look for opportunities where nobody else is looking, this is when outsized returns can happen in portfolios.
Let me turn the conversation toward back to Joe, average investor, me. So when do I make that transition from passive into an active role? If I'm younger, I don't need that help. Right. When do I need to make that transition?
I think when you start feeling the anxiety. I mean, I think this chart really explains it, right? Investors between the ages of 50 and 64 years old agree that protecting gains from market downturns is a key priority. There just becomes this point in your life where all of a sudden you start getting this anxiety because you know, hey, I'm pretty darn close to needing this, right? I'm going to need this money in the next 5 to 10 years. We call that the financial red zone. If you're going to need those dollars in the next 10 years, then it's time to start putting together a retirement plan that's going to protect those dollars and ensure they're going to be there for the rest of your life.
And if you're like me and you're in that red zone and you're feeling some of that discomfort with the market as high as it is today, now is a great opportunity to jump on the phone and be one of our next 10 callers. Calling the number on your screen will entitle you to a complimentary financial and retirement review of your entire plan. Casey and the team really care about helping you make the best decisions you can going forward for you and your family. So be one of the next 10 callers at the number on your screen, and Casey and the team will sit with you and help you find your very own purpose-based retirement. We've got to wrap things up today, but I want to remind you that you can always go to the purposebasedretirement.com to find more about one of Casey's books. Visit us at howardbailey.com or info@howardbailey.com gets an email to Casey's desk. We'll see you next week.